Have you ever wondered how empires fall? It's not a sudden explosion, it's a slow, predictable burn. And the scariest part, every great power in history has followed the same script, a cycle that seems impossible to escape. This isn't just about ancient Rome or the British Empire. It's a timeless pattern that's unfolding right now, and understanding it is crucial because history shows that no one gets a pass. It always begins with strength. Picture a nation at its peak. The economy is booming, people trust the system, and the currency is rock solid. Think of early Rome, the Dutch Golden Age, or post-war America. This success breeds incredible confidence. With full coffers and a bright future, governments start to think bigger. They build monumental infrastructure, expand their influence, and make grand promises to their people. Why not? The money is there, the power is real, and it feels like the good times will last forever. This is the golden era, the foundation upon which the entire cycle is built. But then a quiet shift begins. It's subtle at first, almost unnoticeable. The ambition that fueled the golden age doesn't just disappear. It gets bigger. Government spending starts to outpace its income. The grand projects, the social programs, the military might, it all costs money. A lot of money. The initial response is logical. Raise taxes. But there's a limit to how much you can tax people before they push back. So governments turn to a more convenient tool. Debt. At first, borrowing seems like a magic solution. It papers over the cracks without causing immediate pain. The markets stay calm. The economy keeps chugging along, and most people don't even notice the growing mountain of IOUs. It feels harmless, like a temporary measure. After all, a powerful nation can always handle its debts, right? This is the moment where the path diverges. Instead of tightening their belts, they double down, convinced that growth will eventually solve the problem. The seeds of the future crisis are sown here, in this period of deceptive calm. This is where things get really interesting, and frankly, a bit frightening. When the debt starts to become a real problem, when it is so large that just paying the interest becomes a major expense, you'd think the logical step would be to stop spending, to reverse course. But that almost never happens. Why? Because cutting spending is politically painful. It means taking away benefits, cancelling popular projects, and admitting that the party is over. So instead of fixing the problem, governments change the rules of the game. This is a tale as old as time. In ancient Rome, emperors started diluting their currency. They'd take a silver coin, the denarius, melt it down, and mix it with cheaper metals like copper. They could then mint more coins from the same amount of silver, allowing them to pay their soldiers and fund their expenses. To the average Roman, it still looked like a denarius, but its intrinsic value was collapsing. Today, the methods are more sophisticated, but the logic is identical. We don't have silver coins, but we have central banks. Instead of diluting metal, modern governments engage in what they call quantitative easing, or expanding the balance sheet. It sounds complex, but it's just a high-tech version of printing money. They create new digital currency out of thin air to buy up their own government debt. This injects liquidity into the system, keeps interest rates artificially low, and makes the debt look manageable. The method changes, but the goal is the same. Create more money to pay the bills without making the hard choices. This is the most dangerous phase of the cycle, because everything looks fine on the surface. The stock market might even be booming. People see the government taking action and feel reassured. Confidence returns. But beneath this veneer of stability, a silent cancer is spreading. The value of your money, your savings, is being systematically eroded. Each new dollar, pound, or euro printed makes the ones already in your pocket worth a little bit less. This isn't a market crash. It's a slow, invisible tax on everyone who holds the currency. Trust, the bedrock of any financial system, begins to crack. It's a quiet decay, happening right under our noses. History is littered with examples. After conquering the New World, Spain was flooded with unimaginable amounts of silver from its mines in Bolivia and Mexico. They thought they were the richest empire on earth, but they spent it as fast as they mined it, on endless wars and a lavish court. This massive influx of silver, essentially a huge monetary expansion, triggered rampant inflation across Europe. The Spanish Empire, despite its immense wealth, eventually defaulted on its debts multiple times and faded from its position as a global superpower. Then there's Great Britain. For centuries, the British pound sterling was the world's reserve currency. As good as gold was the saying. But after 2 devastating world wars, Britain was massively in debt. They tried to maintain the pound's value, but the economic reality was undeniable. Their industrial base was shrinking, and their debts were enormous. In 1967, they were finally forced to devalue the pound, a symbolic moment that signaled the end of its global dominance. In every single one of these cases, the leaders believed their situation was unique. They were convinced they could manage the decline. Roman emperors, Spanish kings, British prime ministers, they all thought, this time is different. They believed their tools were more sophisticated, their understanding of the economy more advanced. They thought they could control the outcome, but they were wrong. So, what does the end of the cycle look like? It's important to understand that collapse doesn't always mean chaos, riots in the streets, and a Mad Max-style apocalypse. Sometimes it's much quieter. It can manifest as persistent, high inflation that wipes out the savings of a generation. It can be a currency reset, where a new currency is introduced, or the existing one is drastically devalued overnight. It can lead to a loss of financial power, where a nation can no longer afford the military and global influence it once had. Think about it. The decline of the British Empire wasn't a single event. It was a slow handover of power to the United States. The pound was gradually replaced by the dollar as the world's reserve currency. It wasn't a collapse. It was a transition. Sometimes the most profound changes don't feel like a crisis at all. They feel like a new normal. People slowly get used to their money buying less, their country having less influence, and their children having fewer opportunities than they did. The crisis becomes normalized, and this brings us to the core reason why this cycle repeats again and again without fail. It's not because leaders are stupid or evil, it's because the incentives are always the same. For a politician, the choice between making a painful, unpopular budget cut today and kicking the can down the road for someone else to deal with in a decade is an easy one. The incentive is to spend, promise, and borrow to stay in power now. The long-term consequences are always someone else's problem. This fundamental conflict between short-term political gain and long-term fiscal responsibility is the engine that drives the cycle. The promises get bigger, the debt grows larger, and the currency gets weaker until something finally breaks. History doesn't repeat because governments fail to learn from the past. It repeats because human nature and the incentives built into our political systems never change. And that is the cycle that, so far, no government in history has ever escaped. Thanks for watching. If you found this perspective on history and economics interesting, make sure to like this video and subscribe to the channel for more content that challenges the way you see the world. See you next time.